market in the last week. We've seen the NASDAQ pull almost, we touched, I think, 448, the kind of the toppy top, and then we crashed to 414 by Monday. That was a 7.5% NASDAQ drop. We're seeing the indexes pull back meaningfully, headed towards a 10% correction right now here in April. It's been an exciting time to watch things kind of unfold. It's been interesting to watch too with what was it? I guess since I've been on with you last, what happened on Friday? Well, we had a near, World War III type of event on Thursday night. Everyone was afraid that we might not wake up in the morning, that, Israel was striking potentially nuclear sites. There was a whole bunch of rumors, war. The number one thing I've said this whole year has been geopolitical risk. It is the number one thing to worry about in your portfolio. Geopolitical risk can translate into potentially rates coming down, potentially inflation rising, oil going crazy, ultimately inflation rising. It can turn into potentially conflict for your investment portfolio. Some sectors do really well in war. Some sectors don't do so well in war at all. So these are all things that are important. In my personal update, what has been going on in my world, I guess, since I've been following the markets very, very closely, my stock portfolio is up 42% on just in April here. So my stock portfolio up, I guess that's like $300-something thousand, which has been great to see that big rip. I am trying very hard to close my account and not trade it. I've set parameters that as the market continues to fall, I continue to just buy the dip. So tomorrow, if we look, what was the catalyst for, if you look after hours, it's down 1.2% on the NASDAQ. Reason for that being Meta, I guess it actually beat on earnings, but I guess didn't deliver on some of the other things that investors were kind of hoping for. So that was interesting. We've seen a number of things that have kind of sent things lower. If you look at the fear greed index, I like the fear greed index. Type in on Google fear greed index, CNN or whatever. You can bring it up, and they have fear greed index, and the fear greed index hasn't read this badly in terms of fear since last October. And last October, we had a 12% drop correction. The time before that, the fear greed index was at this level, was in August. We had the correction of 7 or 8%. Where is the bottom? Hard to tell from the fear greed index. But again, we're reading like a reading of 30, I think will be 31 tomorrow. And you get into the 20s in terms of fear greed, usually you want to long the market. So that's usually when you want to stop getting too greedy on your shorts. And then when things are really, really greedy, like we were for the last year, any other time except for those 3 dates I just mentioned, we were in extreme greed territory, which is dangerous. I think to a large extent, it's very dangerous, right? So, yeah. Oh, my chat is not working. If you guys are in the chat, I can't see it. It's my chat's frozen. I'm gonna try to reset it here. Anyway, I'll keep going with the live stream. Sorry, I'm a few minutes late as well. I'm feeling a little under the weather because my daughter from kindergarten brought home another flu, and I've been dealing with some stuff with her, and didn't get onto the chat till just a couple of minutes too late. So anyway, welcome to the show. If you're just joining the show today. It is interesting times, to say the least. I think in terms of rate cuts, the challenges that we're seeing geopolitically and the challenges that we're seeing locally are differing. So and from a local perspective, we're seeing, at least in Canada here, pain. We are in an economic recession here in Canada. GDP is not doing well consecutively. We are not strong with the US. Our housing market is teetering on the verge of flatline, I would say. It's not going down, but it's not going up like you would expect it to go up. My forecast has still been a hot spring. I think we'll still get a relatively hot spring, but if you adjust for the seasonality, we may get 5 to 7% rip up in real estate prices right now in the spring. But I think if you adjust for the seasonality, not as great, and less than I think many were expecting and hoping. That's driven largely by the fact that in Canada here, rates are not coming down. I think they will my forecast is the first cut we get this fall. Now, that could get delayed if there are geopolitical concerns. I'm hopeful that the higher for longer plays out into 2023 fall. We can't afford a 1970s repeat. Although there's a lot of writing on the walls when you compare the two situations, we may go through what went down in the 80s and 90s. You gotta remember that in Canada, for a 12-year period, inflation crushed real estate. So that was interesting. If you look at most of what fueled, I think, what we had in the 90s. Like in the 90s, in 1990, if you bought a house in Toronto, by 2003, that house was worth the same as you bought it for. And in terms of inflation, was worth 15 to 20% less. So the prices went nowhere for a decade straight. Could you imagine for like 10 years or longer, house prices just stayed the same. There was no increase every year. It was like the same all through the 90s, early 2000s. That was a segment of time where the capital gains tax rate went up significantly, just like it's doing now. Canada just announced a new tax program, as you guys know, where inside of corporations, you're going to tax, the inclusion rate is 66.67%. Not to be confused, I know a lot of people are confused thinking that's the tax rate in Canada. It's not. It's 66.67% inclusion rate times your marginal tax bracket. So if your marginal tax bracket was at the maximum in the 50% range, then 66.67 times 50%, or a 33 to 34% total capital gains tax effectively. Now, the US capital gains tax right now is like 37%. So Canada is still more attractive from a capital gains perspective than the United States, especially when you factor in the new, bill that Biden's trying to put through to increase capital gains tax rates into the 40-something% in the United States. The long-term capital gains rate being better if you hold the asset for more than 2 years in the United States. But in Canada, we don't have that. We just have like, hold it more than a year, it's a capital gain. There is no treatment. If you hold it for a long time, or if you hold it for like a year and a half versus 10 years, there's no difference really. Canada has some cool things though. From a tax perspective, I don't want to rag on Canada too much. Canada is an amazing place in a lot of ways for the 99%. What do I mean by that? Well, in Canada, if you make, this is a problem, I think, from a policy perspective, it doesn't incentivize the right things, but it is what it is, and I'll share it with you. It's interesting because in Canada, if a family makes $30,000 a year, they pay zero tax at all. If their family income is $40,000 a year and they have kids, then they get Canada Child Benefit of $600 and something a month cash tax-free for each child. So and the clawback on that is so effective that if you actually work with kids in your family, you actually can get not only like tax, but clawbacks that are another 30 to 40% of your income that are lost. They take clawbacks when they take away a grant they would otherwise give you. And so as your income scales to, I think it maxes out at like 100 and something grand a year, then they'll slowly claw back your Canada Child Benefits, your Ontario Child Benefits, your Trillium, your GST rebates, your carbon tax rebates. We have a whole bunch of money the government gives back to people. Basically, suffice to say, if you make less than 100 grand a year, you probably take more from Canada than you give back to Canada. That's just a fact. The 1% are carrying the sleigh. They're carrying all of the weight and the pain. But Canada has some amazing things too. So what are some amazing things I love about Canada that I wanted to kind of harp on? Because a lot of the energy on social media right now is like anti-Canada. Leave Canada, forget Canada, let's go somewhere else. And while I agree, some of the sentiment is warranted, the real effective capital gains tax is going up for corporations and for anyone earning more than $250,000 a year in capital gains income. That increase from 50% to 66.67 inclusion rate, not tax rate, inclusion rate, which is effectively halved. So you're talking about like effectively almost 9% increase capital gains total tax paid. On $1 million capital gain, that's 90 grand more in tax you're going to pay. Canada has some really awesome things too. Like, for instance, your primary residence is completely tax-free, but in the United States, you pay tax over, I think, $250,000 a year in profit when you sell your primary residence. So if you had like 100 grand a year in appreciation on your house and you went to sell, you might pay some tax on that in the United States. In Canada, you buy a house for $500,000, live in it for 10 years, it's worth $5 million, with inflation 10 years down the road, all of that completely tax-free in Canada. So when you sell your primary residence, which is the main way people save and build net worth to retire, really, in Canada, it's all tax-free. Whereas in the US, once you get past, I think it's $250,000 or whatever the limit is these days, when you get past that limit, all the rest of that gain on your house is taxable. So that's a big difference. Another big difference in Canada is we have the one-time sale of a privately owned Canadian business. So if you build a business from scratch, you get preferred capital gains treatment on the first 1.25 million. It's completely tax-free. That's per spouse. So if a husband and wife build a business, sell it for $2.5 million, the $2.5 million is completely tax-free in Canada. You get to use it one time in your life. Everyone should use it before they leave Canada. So go build a business. If you're going to leave Canada, a lot of people message me like, oh, I'm leaving Canada. I'm like, go. You're rich. A lot of these people leaving are rich. I'm like, you're rich. You can go quickly build a business or buy an existing business, then go sell that business in a year or two from now and collect $2.5 million tax-free. Definitely do that before you leave Canada. I would say that's up on the list of things you need to do. It's designed so that when you retire, you get a nice big kick and it's tax-free. The primary residence being tax-free in Canada, super huge benefit, really overpowered in comparison to other countries where they tax the primary residence gains from whatever the capital gain is on that. So big advantage in Canada. We also have like, if you can keep your income inside of corporations here in Canada and you can keep your income low personally, this is messed up and I probably shouldn't, but like I have 3 kids. You know what the government's going to pay me this year when I file my tax returns. I'm going to keep all my income inside my corporations. And personally, I'll keep my income like 35,000, really low, right? I'll draw a very small amount of dividends from my corporation. I get $1,800 a month cash from the government for my kids. They give you a Canada Child benefit to help enrich your children's life. $1,800 cash. It's like almost, that's equivalent to like $2,800 a month pre-tax income if you consider a normal tax rate. So it's really overpowering when you think of like, I can choose how much income, like most doctors, dentists in Canada, most professionals have corporations, realtors included. And that's huge. You know, I think that it's interesting when we think through how great Canada is in so many ways. And like, what are some things, being back in Canada, and I talk a lot on this channel about how much I love Florida, and I go down there every winter, and the weather is truly fantastic. And Canadian weather in the winter is truly horrible. But I come back to Canada, and I notice some things. Things are cheaper here. When you adjust for the 38% currency difference between the United States dollar and the Canadian dollar, my grocery bills, adjusted for both the Canadian dollars, are 20 to 40% cheaper than Florida here in Ontario. So it's cheaper to live here. Housing's gotten crazy in Florida. When you adjust for currency, it's brutal in comparison to Canada. I think Canada's a cheaper place to live in general. The food tastes better. This is a weird thing, but like in Ontario, I go out and I go to a steakhouse and have a nice steak. Or even here, we buy from a local, we buy a cow from a local farm, local butcher. They drop it off in our freezer. So I have good quality meat here in Canada. And when even if I don't, if I go to Costco and I buy steaks, and I go in the US to like Trader Joe's or, you know, where else do you, Publix, those kinds of stores, the cost difference is huge. And the meat quality isn't as good. Like their chicken is tough when I eat it there. I'm like, why does the meat taste worse? Is it full of like vaccine steroids? So I go try their 100% organic, you know, meat in the United States, and it still doesn't taste as good. I don't know. The quality of the milk, the taste isn't the same. Some of the foods that I like just don't taste the same. It's weird, very, very weird. So I just want to mention that strange occurrence. When you move to the US, you'll notice that, because I test ran that, right? We lived in the States for, I got a couple of years of my life I've spent now living. If you add up collectively how long I've been in the States, probably a couple of years of my life I've been in the States. So I started to appreciate Florida and see what it's about. But there's something amazing about Canada's culture. Like the people in rural Canada, not in this, you go to Toronto, Toronto's like a third world fucking nation. Toronto's terrible. I'm sorry if you live in Toronto. I go to Toronto, I breathe in the smoggy air, I feel horrible, people feel ignorant, the culture is not even Canadian anymore. When I walk around Toronto, I don't even feel a Canadian culture. But I go to a small town in Ontario, and people are kind in a way that they aren't in the United States. In the United States, people are out for themselves. It's very capitalist, it's very selfish. I'll give you an example. Like, I'm doing business in the US, and let's say I do business in the US and I hire someone. In Canada, person would give you like notice and be like, hey, you know, I can't come in today, I'm not feeling very well, or I'm not going to show up to do the job, I got another job. They give you notice. It's interesting, in the US, people are ignorant. Like in general, in Florida, I've noticed people are ignorant. They'll just not, like contractor just not shows up. No text, goes ghost. Not all, but some. And there's a lot more of like, especially in backwoods Florida and some of the smaller areas of Florida, I noticed that people are very like hillbilly-ish, and it's not even the right word to use, but like just rougher around the edges in a way that like Canadians are kind. We're saying sorry. We're like, go ahead of me. Like I'll hold the door for you. There just isn't that same courtesy. Maybe it's because I'm in smaller towns in Ontario, and I'm like, if I'm in Toronto, I'm sure it's a little bit more rude, but I don't know. I'm noticing cultural difference between Florida and Ontario where I am, especially like if you compare it to like Vancouver, even Calgary. People in Calgary are kind. People in West Palm Beach and Daytona Beach especially, are not kind. I walk the streets and I fear for my life late at night. I walk the streets in like this nice suburb of London where I live. I feel no danger 2 a.m. I will sleep on the sidewalk and no one will walk by me. I'm not afraid at all. So there's a difference there that I've noticed. And maybe it's just, again, not really a proper data set. So it's hard to really draw any conclusions from that. But my experience where I'm living here to where I've been living in Florida, there are some differences. Now the weather is amazing, and I found some great people in Florida too. So Florida is awesome, and I could see ourselves relocating there at some point. Just cultural differences that I've noticed. Things I miss being back here in Canada. You know, it's sort of interesting. I'm just sharing that with you guys. I don't know if other people feel the same, but you know, the people The nicest people that I've met were in Calgary and in outside of Vancouver. Really kind people, and some of the smaller cities in Ontario too. Like if you go to cottage country in like Huntsville or Grand Bend, Ontario, just people are kind in general there in a way that, that kindness isn't the same in the United States. People are very much more selfish. So something to kind of share. All right, let's go to the Q&A for a second. Hello from Alberta. Hello, David. How you doing? Someone says, real estate prices are coming down. 90s prices dropped. True, to an extent, in terms of real buying power, prices actually did drop. They were pretty flatlined, down about 6%. But compared to inflation, the real return was very bad because inflation was like higher than normal, rates were high, real estate actually did not do so well. However, people who invested through the 80s and 90s and had successful construction operations and flipping operations that were tight on cost control did very well. And people who were cash flow positive and didn't lever up in dangerous ways. So I'm talking if you get, you don't want to be getting adjustable rate debt that could float to, I don't think they can get much higher at this point, but it always could. You want to make sure you're not taking on crazy amounts of debt and you're not taking on debt you can't service. That's where you can fail. Where Dave Ramsey failed was he took on a lot of debt, really 19-20% interest debt, and took on a lot of risk and didn't have a good operation. So real estate is a business like any other, and you can make good money in real estate even through this recession. So I'll leave that there. The last few years have been crazy. 1988, they raised capital gains taxes 67%, and then 2 years later, 75%. That's true, they did that. The taxes they're bringing back right now, Trudeau's trying to bring back right now, they put those policies in, and it was not good for real estate. The thing is, I don't think that those tax policies necessarily caused what happened. You got to remember that in those times, we were in a situation of driven largely by high interest rates, I think was what penalized the economy in that way. And like just bad management. And so I think if Pierre gets in a year and Trudeau gets out, that's what will happen. If you poll Canadians right now, conservative majority will win. If there's an election today, we'd have a blue conservative majority. And he would repeal all of the things that Trudeau is doing. Clearly, he's like anti all of those policies. And he's pro-growth and pro-economic growth. And so, Canada could turn around. So before you leave, just remember that things can turn around in a year, and it takes a year just to leave. So get your ducks in a row, be prepared. I always recommend having a second passport, invest in other countries, because in case you need to leave, you need to be able to. If we have another end of the world type vaccination event, and you don't want to be held down and drugged without your will, against your will, and told you can't leave your house like what they did in Canada, you need to be prepared for that. That said, I don't think one of those events is going to happen. It may not. We may have learned from the past. Hopefully we have. And so I don't know if another repeat of that will happen. That said, I'll always be prepared to be agile through these times. And that's taught us that we can't rely on, on one government to take care of us, or can't rely on anything, really. We need to be flexible and agile. Tesla misses earnings and goes up, and Meta crashes. Irrational. Yeah, so Meta actually beat on, in terms of like earnings, in terms of revenue guidance, in terms of spending on their metaverse projects. If you look at the recent financial report tonight, I took a quick look at like 4:30, and the quick skim that I did looked like they beat on most metrics. I was like, oh, so interesting that they beat, and then they go down like 15%. And then, Tesla also, rallied. I had a little bit of Tesla shares I picked up at 139. I tend to only acquire stuff that gets beat up really hard, but there's real value, and Tesla was down 40% on the year to date. So I picked up a tiny little bit, like $5,000 worth, and it jumped like 15%. So I took a 15% profit and harvested most of that. I may nibble back in if it dips. I think we're going to be in for correction territory. We were on a run from October 31st to basically like a week and a bit ago. We rallied up for 5.5 months straight. We had no down weeks at all, period. Every month was just up, higher, 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 higher. That kind of rally is rare and oversold. I think that too many people were buying. It was just way overbought, and the media was really pushing that the stock market can never go down. They were just overselling this hype, and you could feel it. Like I was looking at my social media feeds, and I'm like, there's no bears left. And all the bears are even like, I don't know, like, don't short this market. And like when that happens, and there's extreme greed, as Warren Buffett says, when the market is greedy, you got to be fearful. When the market is fearful, you got to be greedy. And I think that there's been a lot of greed for a long time. It ran a lot higher than I thought it was going to go. But we'll see. I don't, who knows where it goes. To be honest, if anyone can tell you that they know where things are going to go into the future with any degree of certainty, they're lying to you, because no one has a crystal ball. No one knows. Not Jim Cramer, not NBC, not the stock traders that you follow. No one has any real idea what's going to happen. We're all guessing. The best traders in the world who have the best accuracy and the best track records, they're right like 57% of the time. They just don't lose hard when they're wrong. If you study like the professional, the best fortune tellers in the stock world who have the best track records, most of them are investing for underlying fundamentals like Warren Buffett. And that's where you spend deep amounts of knowledge going deep on a company and understand their financial background and then invest based on their financials. And again, even that is like what happens to their financials in the future. Who knows? The world values growth now more than current performance for some reason. They love growth. Right now we're in a growth AI hype cycle. And so the underlying, I guess, solution here is if you don't want to spend, if you have a team behind you of a few friends who can all study the market and spend 100 hours a week reading deep financial reports and becoming subject matter experts and spending the time studying the charts, and you want to do this, you get up at 5 a.m, you've done your prep work, and you want to trade, okay. For everyone else who's sane, because you don't actually the person who says they want to do that, like, you're fucking insane. Who wants to actually do that? That's a horrible life quality. So my point is this: no one wants that. No one does the work. And because they don't put in the work and they don't have the knowledge, you're better off to buy the entire index, buy the market, buy a piece of China, Russia, India, the emerging markets, buy a piece of the United States, buy a piece of Canada, buy a little piece of everything. And over the grand collective, you'll make your 10% return. You'll be safe, you'll be happy. And over the long term, you'll beat 99% of stock pickers and traders and most funds out there net of fees. So that's the actual meta-analysis here, is like, don't try to pick stocks. You can if you want, but you'll probably get smoked. I mean, 1 in 100 traders win over a 10-year period. 1 in 1,000 win over a 25-year period. 1 in 1,000. So you think you're the 1 in 1,000. And by the way, that 1 in 1,000 is probably a PhD with a team behind them of quants, some of the smartest people in the world, spending insane amounts of time to develop a small edge. And that's all you need, is a small edge. It is hard as your stock account grows over time to beat the stock market. So if you do beat the stock market for a while, eventually it grows so big that you can't beat the stock market because you get too big. And so that's an interesting conclusion that I've learned in the 5 years I've spent studying stock traders and options trading, and I've done a lot of it. I've had great runs and I've had great losses, and such is the way of anyone learning and playing in the stock market. Don't do it. The underlying conclusion is it is stressful and you can't beat the market. Probably most of you watching this can't beat the market. Though we like to try. A lot of wealthy people play with stocks, and a lot of poor people, unfortunately, play with stocks too. And the underlying advice is, most of you watching this don't have an edge in beating the market. You're not smarter than the financial analyst. You don't have the resources behind you. You're not putting in the 100 hours a week because you're busy with other things. You have a full-time job or a business that you're running. And if you have those things going, you can't be a good stock trader. You just can't beat the guy who's spending that time. The person who got up at 4 a.m. to read the report is who you're betting against. The person who has a team behind them and they're spending the time, they're smart, PhDs in finance or masters in economics, not that you necessarily have to have those qualifications, but you have to have spent the time and have the accolades, not necessarily on paper, but have spent the time and earned the right to have an expert opinion. And I definitely have not. And I definitely cannot beat the market over the long term. I continue to try, and it's more of an experiment for me. I will not put a large percentage of my net worth into a stock portfolio that I control, unless it is buying the entire market, buying small pieces of every sector, diversified and balanced, because then you can't lose. Never put all your eggs in one basket. Never go all in unless you control that basket. So if it's your business, people who consult with me are like, hey, Mike, I have this business and I have this edge in this business, and they explain to me and they can show me from a track record of success that they're doing well in that thing. I'm like, go all in that. Maybe take a third of what you have and put it in something else to diversify. But majority of your wealth should be going into that thing that you have a superhuman advantage at doing. For me, that's real estate. Like, I can go buy buildings at 30% off. That's my superhuman power. I can go in, my acquisition stuff is really good. I'm also fairly good at going in and seeing value where other people can't. My lens for design or for optimization is really good. And in that sphere, I have an edge. I have a competitive edge that other people don't have. And the more time I put in, the better my result. Whereas in the stock world, sometimes you spend more time and you don't get a better result because you're not in control. It's not your business. You're investing in other people's businesses, and other people are management. And if you don't know management personally, you don't know how they're operating and acting, you can't really know the ins and outs of the business that you're investing in. So I like to invest in private equity space where I have my control of the business, or where I know the business owner, and I can lean in and have a real impact where I'm in control of management. That gives you an edge. That's when you become an insider. That's when you have what's called an alpha. An alpha is an edge. And so that's what I recommend is if you're going to invest in something and you do have an alpha, invest in your alpha or in your edge. That's what you got to do. Yeah, lots of people are losing jobs right now. Tesla was support, Meta was resistance, using technical analysis. Technical analysis is one of 5 trading methods and is the least reliable of the 5 when studied. The most reliable over a longer period of time is actually looking at financial statements. So it's looking at the value investing style of valuing what a company is worth, looking at their earnings power value and their net asset value and contrasting them against each other to look for real value. That is the only way I think you have a real edge, is if you can combine technical analysis with value investment fundamentals. I don't know that I don't have the time to do, like when I would study a stock, I took value investing at Ivy, and it was modeled after Ben Graham's style of value investing. And it would take us like a week to properly analyze a stock to determine if it's undervalued. I would spend like 60 to 80 hours to really be able to plug in all the variables to the model to determine what its real value is. And even then, it was very unreliable, and it can take years sometimes to realize from where it's currently trading at to where its real intrinsic value is. It can take years sometimes. So anyways, all that to say, for me to do that for a whole portfolio, I would need a team behind me. And so then, yeah, that begs the question, like, who do you outsource that research to? And if you're not reading research reports and you don't have a team that you're analyzing all these to, then how do you have an edge? And you don't really, is the challenge. And technical analysis, almost all of the models built on the rules of technical analysis have not provided an alpha to beat the market with a large amount of capital over a long period of time. So that tells me that it's been impossible to replicate technical analysis being of huge value for a portfolio over time. What happens is the guys who think that they can get in at the right time and get out at the right time, most of what happens is like the ones who are trying to time it end up missing the big rips, or the ones who are staying in too long end up taking up too big of losses, and it's hard for them to catch up to the market. All in all, I would say for my audience that's watching this, who are like, you might have a degree in business, or you might be an accountant, you might have some business acumen, you probably aren't going to beat the Wall Street traders. You're not going to beat the best of them. And why would you want to? Why would you want to? The quality of life of being a good trader is shit. Just a fact. Like, they have horrible lives. They have to work really hard, and the stress is really high. Heart attack, baldness, all common traits in the finance field when you're dealing with market fluctuations. Now, I'm talking about bringing 24-hour stock trading to the NASDAQ. That would be scary. I will not be trading stock at all. I would just hold and look at it every few weeks if that happens. Honestly, I'm going to probably go all in on real estate because that's where my superhuman ability is like business and real estate. Those are areas where I can deliver outsized returns. What do you think of gold and silver? I think a lot of people are piling into gold right now. It's reaching some real highs. So I don't like to buy into things when they're reaching their new all-time highs, and gold is close to its all-time high. So when fear is at a maximum, is that a good time to jump into gold? I think we'll probably get another test of a top, which would be a better time probably to buy gold. But I don't like gold as a large percentage of anyone's portfolio. I know a lot of guys, like I am a bearish dude, but I don't love gold that much. I think gold's pretty overvalued given its actual use cases. There's a lot of speculation involved. It feels a lot like a lot like Bitcoin in a lot of ways. Like I have a small percentage of my portfolio in gold maybe. You can't really cash flow gold. There's no, like, it's just an inflation hedge, kind of, sort of. If you inflation test gold, it actually doesn't do that well. Real estate and land way outperform gold in terms of inflation hedge. So if you want an inflation hedge, gold isn't even that good. Bitcoin is really more of a tech speculative play than it is an inflation play. But if you're really worried about inflation, you think that the central bank will continue to allow inflation to run higher than target, which I actually believe that, then what you want is levered assets. You want to own assets that are not super volatile, because the volatility is what kills you when you apply leverage to something. So Bitcoin as an example. If you apply the kind of leverage I apply to real estate to Bitcoin, you get liquidated to zero when you go through the next bear cycle of Bitcoin. So then Bitcoin's not that great because you can't really lever it. So I don't know, Bitcoin could be 1 or 2% of the portfolio in a balanced portfolio. Gold could be the same. Silver, gold could be the same. You know, other precious metals like copper are also great as inflation hedges, I think. Their utility value is better priced in. Copper is a very useful metal and it trades much cheaper than gold. And you can use it in electrical applications. You can use it in, you know, plumbing applications. There's many places you can use copper as well. Honestly, just like many of the commodities, if you are bearish, commodities tend to do fairly well against inflation. So there are tons of inflation plays you can make out there, but I like real estate. I really do. I think that when inflation runs wild for a long time, real estate eventually catches up. Not always right away, but with leverage, it becomes very attractive. Because you got to remember, like with real estate, I can go 5-to-1 leverage, and the real estate produces cash flow. So if the price of real estate, like look through the 90s, look through the worst case scenario. I knew people in the 90s investing. I talked to them. A lot of them had positive cash flow here in London, Ontario. And they ran their businesses and they made their $500 a month from the rental properties. If they had a large portfolio, they were cash flow positive, probably making a 10 to 12% yield just on cash flow if they own the right kinds of multifamily properties. So you get a 12% yield, a percent a month return. And then that's if the price goes down. You still make your percent a month. You don't care about selling. And in a 10 or 20 year period, eventually real estate wins. And the biggest thing that is going to be different than the 90s this time is our inflation, or our human inflation, our immigration policies, our human inflation policies. Our immigration policies are very, very strong. A lot of people want to come to Canada. It's one of the best ranked countries in the world for good reason. Like Canada is a place that many people want to go. Many rich people actually want to go to Canada, as strange as that sounds. What they do is that they leave their businesses offshore in China and they come here and they hide some capital here. No, Canada's a beautiful country in terms of like culture. It really is a special place, and it will always hold a special place in my heart. And I think that most people who come here, maybe not to Toronto as much. I found the culture in Toronto is it's one of the worst cities, I think. Although like as an English speaking Canadian, try going to Montreal or Quebec if you don't speak French, and you'll get a nice warm reception of like a finger up your ass. They're some of the rudest people if you don't speak fluent French. Especially to foreigners, I've found heard stories of such, and been myself as well. And anyway, boom, boom. Somebody sour. What's that about? Oh, someone's TikTok stock advice. I don't even use TikTok, to be honest. Paul Jones says hi. Chung, how you doing? James says, hey, Mike, hope you're doing well. Thanks, Johnny Bahama. Contrarianism for the win. How is London market this spring? We're up slightly, but not the rip that I was hoping for. I would say things are up like, I have to look at the data, but I think we're up like 5% right now. Like it's a meaningful swing. $1 million house will sell for like $950 in the winter, and it'll sell for $1.05 million in the peak of spring. We're coming towards the peak of spring. There's a lot of fear, I think, in terms of where rates are, and a lot of Canadians just don't know what's going to happen next. So when does the rate cut happen? I think a lot of people are holding off and waiting on the sidelines. There's a lot of cash actually sitting on the sidelines waiting to get involved. People are saying, oh, people are going to sell their properties because the capital gains tax, they want to lock in. It's like no one's getting their property listed and sold in time to beat the June 25th capital gains, increasing inclusion rate. It's just not going to happen. It's an aggressive timeline. Like when you go to sell a property, you have to go and like you'll meet with your realtor, you make a list of things, or you'll go there yourself, you make a list of things you have to do. That'll take you 3-4 weeks to the handyman. Then you'll get the property ready for market. You'll take photos, you do a virtual tour, you get the listing paperwork done. Now you're 6 weeks in, it'll hit the market. People will look at it for 30 days, and this market might take longer than 30 days. If you're in a rural situation or where the property is not as in a desirable or a hot area where there's not a lot of options, it might sell in the market for 2 months. So now you're at like 3.5 months. And then there's someone puts an offer in, they go do home inspection, financing inspection. Now you're at like 4 months. They're closing a month after that. So you're looking at 5 months from the minute you decide to sell to when you actually get cash. And that's a misconception, I think, for most people in real estate is like they think they just get cash like that. It doesn't actually work that way. Real estate is very illiquid. It takes a long time to go from wanting to sell to sold cash in hand. And that's a good thing in a lot of ways because it takes time, which is nice. And on a cash flowing asset, You shouldn't ever be in a rush to sell real estate. You should be buying property that's cash flow positive, and every month you're making money, you don't care if it takes a little longer to sell. It shouldn't be a rush decision in a lot of ways, I think. So anyway, that's just a fact for you guys out there who think that you can liquidate by, I see that on social media, and I'm like, who is actually liquidating their properties? No one by June to beat the capital gains tax. No one. Like, that was an article that I saw too, and I'm like, no. Like, that's a clickbaity article, but like, no one's actually gonna execute on that. So it's a nothing burger. Gold and silver are a good investment, he says. You need to beat 15% compounded or you're falling behind. I mean, that's a bit much. I think that probably inflation is like 7% right now, 6-7%. We might get, I think there's a really good case for deflation in Canada. I really do think Canada's going to have a bit of deflation. I think it's possible. It's not good, but for a time we could have deflation. Yeah, disinflation for sure, but deflation possible. Joseph says, how many couple as well? What would you say overall net loss was investing in crypto throughout the years? Do you regret getting into it? So, Joseph, to kind of summarize, I've lost lots of money in crypto over the years. And my biggest loss was in buying the crypto mining operation that I bought. I bought and built a big operation. And one of my key guys who was servicing all of my equipment stole some of the equipment. We had orders not come in from China for machines and cards we ordered. We had challenges with theft. We had challenges with some machines coming broken. And then all the stuff we mined was near the peak, and I held it all, and then it crashed. And so the price of Hydra and all the costs of the crypto mining just didn't make sense in a bear market. So we shut the machines off, and then they depreciated to zero. So crypto mining was a really horrible business model. And that's because I didn't expect the advancement curve to be as aggressive as it was. I thought that the machines could still run. I ran a scenario where they could still run in a bear market, but what I didn't factor in is that everyone else was piling in buying cards and machines. And so there's just so many more people trying to mine the same blocks that you got less, and it became a lot more difficult. So your machines actually produced a lot more. So the technical advancement of the chips was so fast when this AI boom. And that was my biggest regret, I'd say, with the crypto mining. The other thing is I didn't value my time. Like, I'd go out there and have to turn the machines off and on and mess around with it. I have to meet suppliers, pay suppliers. It was a business. It was basically $1 million crypto business. It took a lot of my time. If I had taken that time and that money and put it into real estate, even with the bear market we went through, I probably would have made $1 million. So all in all, lost about $1 million. So that was my experience with that. I'm glad that I'm not involved in it anymore. You can still make money mining. It's just not worth the time for me. My time is too valuable. I'm $1,000 an hour, so I shouldn't be mucking around with $30 an hour tasks. And most businesses, you need scale. So I'm looking to find businesses I can scale. And real estate is one that I can scale, where I can bring the right people in as I get bigger, so I don't have to be involved in day-to-day minutia. But yeah, in terms of crypto, yeah, I mean, you gotta be careful with crypto. People are talking about crypto, 100,000 a token, could go $150,000 a token, it could also go $30,000 a token for Bitcoin. So if you're buying right now at 90,000 Canadian per Bitcoin, it could be 30,000 or 40,000 a Bitcoin a year from now. It may also be 150,000. I think it's a very likely scenario that into next year, if you follow past halvening cycles, we may get another 50% rip in the price of Bitcoin. But the winter cycle may put us at 25,000 USD at the token again. So that risk implicit in that speculative asset is one that I think is a roller coaster, and not everyone's prepared to ride that roller coaster for the downs with the ups. And we think that we can time it, but we just can't. And that was my lesson too on this, is it's tough time. Tough to know when to get in and get out. I'm not perfect either. Sean says, 100% agree, retire time to be good at DIY investment. Happy to sit back and let PMs produce 7-10%. I like to sleep and time with family too much. How much above 10% could I really do? True say, I think that's wise information there, Sean. I would say in general, I wouldn't pay people to manage my portfolio for me. I would go and build my own robo ETF portfolio with very, very low fees, with exposure to everything, or build my own portfolio as such with little exposure to every stock you want. What's interesting, look at the data over the last 100 years, is something like 80% of all of the gains in the stock market are attributed to like a small 1% of the total companies on the index. So of the 500 companies in the S&P 500, it'll be like 20 that delivered 90% of all of the return, and the other like 98% of stocks underperform the market hard. So can you pick the 1% of the S&P 500 that are going to way outsize return? And if you do, you hit the jackpot. But it's interesting to look at, like your NVIDIAs of the world, or your Teslas, or your Apples, or your Amazons, like picking those monsters. Who knows what the next monsters are for the next 20 years? And so that's why we buy the whole index, because we just don't know. Some people say buying like the top 50 can work if you keep rebalancing your portfolio. You get an outsized return. I've seen some different portfolios that are interesting. All in all, I would say picking stocks is dangerous. And I think you should buy a little piece of every stock, sit back and enjoy the journey. And if you want to get involved in the minutia of trying to micromanage, go build or buy a business and invest there where your time actually will equate to more money and outsized return. CAGR on Bitcoin is 71%. You know what the CAGR on Bitcoin was fall of 2022, when Bitcoin hit 16,000 USD. Do you know what the CAGR was on it? So it depends on when you're looking at running the CAGR. Next bear cycle, run it. Lucky tweets or whatever. Look and run it when Bitcoin is in its next bear cycle, which it might hit 30 or 40,000 a token. What's the CAGR on it next year when it's 30,000 a token or 40,000 a token? Again, like that's a reality. And some people, the problem is that this is being pushed by everyone, this Bitcoin bullish sentiment. And the majority of people don't have the risk tolerance to hold Bitcoin through the bear market, myself included. I actually dumped some of my Bitcoin at the bottom, and it felt like shit to do it. But I had a real estate opportunity that I took on that I was able to grow my money, 40, 50%. So I went and took that opportunity. And so it's like, sometimes life happens and you need the cash, and it happens during a bear cycle. And you're like, oh, I can get back into Bitcoin before it rallies again. And you don't get around to it and you miss the rips. So if you're going to buy Bitcoin, be prepared to hold it for the next 10 years if you have to. Like, can you hold Bitcoin until 2034? That's the question you have to ask yourself. Do you have an exit strategy on the horizon that might mess up that investment strategy? And so, yeah, because at certain times, I think it has a good positive return if you get it at the right times. Again, greater fool strategy, right? The only way out of Bitcoin is to sell it to someone else for more. Whereas when you buy a business, the intrinsic value is there in the cash flows that it produces, right? So even if you never sell your stock, if you have stock in Bank of Nova Scotia, as an example, I'm a shareholder of Bank of Nova Scotia. It's trading at like a 10 PE ratio. So it's trading at 10 times its net earnings. So if you buy the Bank of Nova Scotia stock right now and you hold it for 10 years, you get all your money back every 10 years, even if you never sell the shares. This comes back to, I think the dividend yield's close. I might be exaggerating a little bit. It might be 11 years or something. I don't know what the dividend yield on it is on it, but effectively, depending how they reinvest in the business, you're getting a huge percentage of, over a 7 to 10 year period, you're getting back all the money you invested. And that's really nice when you own a business or some underlying asset, you want it to produce cash. And the problem with Bitcoin is, how do you produce cash? Well, there are ways. You could stake your Bitcoin on different exchanges, different places you can stake it, effectively lend out your Bitcoin, and then you get paid back in Bitcoin again. The challenge is, whenever it's not your keys, not your crypto, whenever you lend your Bitcoin out to someone else, there's risk it never comes back to you. So that's where Bitcoin is actually much more interesting than gold. And when there's a safe way to do that with I'm not 100% sold yet that there's an easy, safe way to lend out my Bitcoin. When there is an easy, safe way to lend out my Bitcoin, it's far superior to gold. If I could lend people money in gold right now, imagine you could hold gold. There's inflation adjusted. They couldn't print more of it like they can with the dollars when we do deals in dollars. You could lend someone like 100 grand gold to buy a house, and they had to pay you 10% interest. So I got, like, at the end of year one, I got 110% of my gold back. That's interesting. You could do that with Bitcoin. So Bitcoin is a superior digital gold. The problem is, like, it does have flaws with it too. So am I bullish on Bitcoin? Yes. Suffice it to say, I am bullish on Bitcoin, but I do think that it's going to take a while to get the adoption, and there is massive risk with it. So I don't know if I have the heart to hold Bitcoin through a bear cycle with all of my net worth. Like, some of these guys have majority of their net worth just in like Bitcoin and cryptocurrencies. I don't know how they sleep at night, going from like 10 million to 5 million. It's like, my heart can't handle that, Anyway. Bum, bum. Would you ever liquidate your stocks to go all in on real estate? Yes, I would, 100%. I have done it before. I would do it again. I'll probably will keep a small amount. Like, real estate and stocks are conducive in the way, how do I explain this? So when I buy multifamily buildings, I need to be able to show proof of funds. When I go in to buy a large multifamily building, people need to know that I can actually close on it. And so it's helpful that I keep a small stock portfolio of like even $1 million, something smaller amount. In commercial real estate, $1 million isn't a lot of money. So even $1 million, having that there even if I have large lines of credits that are all drawn down, as long as I can show some assets there, it makes it easier to negotiate on these commercial deals, because it is challenging if you go into a commercial deal broke and say, I'm going to raise the money. No one wants to sell you a property if you're like, I'm going to raise the capital to buy this building. It's like, what? So that makes people feel uncomfortable. And so, yeah, I don't know about XRP, but I will. That'll be that for this stream tonight. I think we went a little. I started late and we went late. It was a long stream tonight. Thank you everyone for tuning in. I really appreciate all the people who came in tonight. If you got value, hit the thumbs up button. Jump in the comments. As always, the secret to unlocking a wealthier you is 3 levers in control of your financial future. Spend less than you earn. Find strategies to earn more, and maximize returns in the difference. That's it. Those are the 3 levers to building wealth. If you can master that equation, you'll be financially independent and live the life that you want to live. At the end of the day, I still believe that the most impactful and best purchase I've ever made in my entire life was buying my freedom 7 years ago. 7 years ago, February. It's been more than 7 years I've been retired. Wow, 7 years since I quit corporate. I only worked in corporate for three and a quarter years, and then before that for 4 years, 2 full-time jobs while I was in school. But my retirement phase has been longer than my grind phase now, which is wild. I kind of feared that I would draw down my portfolio over time, but I'm just a hyper producer. So like, I can't not make $1 million a year doing things actively. I buy buildings, I turn them around, I invest in businesses. I think it's just who I am. I want to produce. That I don't think it's possible that I could draw down my portfolio, but I was curious to see how that would happen over 7 years. I was going to do a study on like drawing down your portfolio over time. But anyway, that's my thoughts on that. And yeah, so you should buy your freedom, guys. It's highly recommended. It is. You'll never regret buying your freedom. You can always go back to work if you want. If you unlock financial independence by building passive income to cover all your expenses, and you don't enjoy the early retirement lifestyle and running your own little, portfolio and managing that, you can always just go get a job. But everyone I've talked to who's chosen this path in life, none of them want to go back and get a job. So highly recommended, worth the sacrifice, worth whatever you have to delay now to have that better later. So anyway, have a happy Wednesday, everyone. We'll see you next week. And as always, you know where to find me on social media at Mike Rosehart. Look for the blue check mark on Facebook, on Instagram. I post stories there, several times a day. If you want to find me on email, rosehartcapital@gmail.com. Yeah, thanks everyone. See you next week.